Hey folks, Saransh from Wisdom Bites here. In this video, I will be talking about stock options. Before I get started, I would like to put a reminder out that all these things that I have learned are riskier investments, and options especially are a leverage play. So they are riskier than stocks. My intent for these videos is to share things that I've learned, and you should make choices of your own volition. This is just me sharing things that I've learned. I was initially thinking of doing a video about trading stocks, but then I realized I don't trade stocks anyway. So it isn't fair for me to talk about things that I've learned a couple of years ago and never used. I'm not saying stocks don't work. In my opinion, options have allowed me to maximize my return on investments once I understood what I was doing and how options work. I've been trading options for a couple of years now. And before getting into the trading strategies that I've been using, I wanted to cover the basics about stock options before diving into details. Having said all of that, let's get into options. Without getting into the jargon of it all, an option contract is an agreement between two traders or parties regarding the purchase or a sale of a stock. The agreement usually involves 100 shares and is what is known as a leveraged trade. So you're dealing with 100 shares of a stock instead of just one. But for the sake of simplicity and understanding, we will consider a single share to understand this concept in this video. Let's assume a stock ABC, and let's assume its value is $100. In a typical stock transaction, a stock buyer would buy a stock from a seller for $100. So the seller gives away the stock that they own, and the buyer gets the stock, and the buyer pays $100 to the seller. In an options environment, the buyer can sign an agreement or an option. If the stock goes higher in price, they can buy it, or they can choose to not buy it. An options contract is thus based on the of one party, uh, assumption of one party or multiple parties about the value of that stock in the future. Let's take a more concrete example. Let us say the buyer wants to the ability to buy the stock at $125 in the future. Now you might be thinking, why would someone want to buy a stock at $125 in the future when it's at $100 right now? Well, what if the stock price is $150 in the future? Buying at $125 would be a bargain then, right? So the buyer gets the right to buy the stock at that amount, but they can choose not to. And what all goes in an option contract is that the buyer has to set a date until which this whole contract is valid, and they have to pay a premium to have this ability or this option to buy the stock. So let's assume the buyer has the option to buy the stock at $125 for a duration of 1 year. So anytime within the next 1 year, the buyer can buy the stock from the seller for $125. So the buyer pays $25 to get the right to buy the stock from the seller at $125 during the next 1 year. They can either buy the stock right away, which obviously they won't, but until the option expires, they can choose to execute the transaction option and get 100 shares at $125, or for this example, one share. The seller gets to keep the $25 irrespective of what happens to the stock. Thus, both the seller and the buyer have some skin in the game, and they're making some money. The seller wants the stock price to go higher, but not way higher. And the buyer obviously is hoping that the stock goes beyond that. There can be a lot of combination of the price at which the buyer can buy the stock at and the expiration dates, and that introduces a whole lot of permutations and combinations. This in a nutshell is a call option, and the jargon terms for what we have discussed until now are as follows. The price at which this agreement is reached is called the strike price. So 125 was the strike price in our case. The amount that the buyer pays for the right to buy the stock is known as premium or premium compensation. In our example, that was $25. The process of the buyer using this right to buy the stock and getting the stock in return is known as exercising. On the seller side, since the contract is being assigned, the process is known as assignment for the seller, what is exercising for the buyer. And that is a brief overview of the technical jargon around options and what an option is. There are different types of options that I'm not intentionally getting into. And what we discussed is a call option. We will get into the specifics of options, and there is a lot of math involved as well in determining in the price setting of the option. But I'm reserving those for the next video. Options allow us to create strategies around how we think a stock is going to perform over time. In contrast, with a stock, you can either just buy or sell. Options allow us to make assumptions if a stock will be range bound or it will go higher or lower, and a lot of other ways of complex strategies that can make things work according to how we assume the stock is going to do. So getting back to my original statement of options giving more return on investments, let us get back to the scenario where stock ABC was trading at 100. And for the sake of understanding, let us say it went to 200. If I had held 100 shares of the stock, I would have made 100 into 100, which is $10,000 of profit on a $10,000 of investment. At the same time, if I had bought the $125 call option, I would have invested 25 into 100, 2,500 is $2,500. And since I have the right to buy the stock at $125 and sell at the current price, I would have profited 200 minus 125, which is 75 into 100, because there's 100 shares involved, $7,500 of profit. So I would get a 3x return on my investment using the options trade, 7,500 on a 2,500 investment. And I would get 1x profit using stocks on the same trade, 10,000 on a 10,000 return of investment. Also, my max loss would, if the stock went to zero, my max loss would be 2,500 in case of the option and $10,000 in case of the stock trade. Thus, if I understand options, because there is a lot more to it than just the simple example I talked about, they are a better investing mechanism than stocks because my return on investment is more and lesser money is on the line. Hope that clarifies a few things about options. If you have any questions, drop in a comment below, or if you would join our Discord server and carry on this discussion there, I would love that. The link to the server will be in the description. Hope to see you there. Peace.